I want to welcome everyone to our second session of Plan Strategically for the Sale or Transition of Your Business. Thank you for joining us at 8 a.m. on a Wednesday morning with snow on the ground. And I was just sharing with everybody that I'm happy about the snow. It's probably not the case for everybody, but I think it's a wonderful thing. So with us today, we have Danny Delaney, Lauren, with Anka with me. We have Doug Hoffman, who is a senior partner with Hoffman Eels, and I just saw Dan Martin come in. Dennis Vacencio, who is also with Hoffman Eels. They are going to walk through some tax considerations a little bit later in the presentation. A little bit of housekeeping. We're going to do a couple of polls along the way, perhaps not as many as we did in our first session, but just kind of helps create some engagement. I'm going to ask you to ask questions, either raise your hand, or on our next slide, I'm going to show you how to ask questions not publicly. You can ask a question of Lauren, who is going to moderate the chat. So just trying to break down every perhaps mental hurdle to asking questions about the content that you might not know, and you can do it in a private way so that people could get embarrassed about these things. So that's where we're at with that. We're going to take a 5-minute break around 9. If you can keep your video on, great. Don't need to. I understand that that could be intimidating for some. There will be a quiz similar to our last session, just to gauge content and what I might need to review in the next session. So here is my screenshot. I'm not sure if everybody is aware, but if you go into the chat, let me just make my little pointer into my whoop, no, not that one. My pointer where is my, I guess we'll do that. So right here, I don't know if you can see this there is a drop-down box. And in that drop-down box, you can select Lauren Richards' name and send her a question. And that way, certainly you can ask it publicly, but if it's a question that you would prefer to ask privately, Lauren will moderate the chat and she can then ask the question of everybody. Because please, we're going to go pretty deep on valuation, and please just ask questions. You will all have sessions with me if you would like afterwards, but certainly to ask questions now, you're probably not the only person. We're going to take a really quick review of some of the concepts that we discussed in our last session. As I mentioned, we're going to take a pretty deep dive into valuation. There's a spreadsheet that I will share with you, but we'll walk through how you use that spreadsheet. We'll talk about valuing FF&E, valuing inventory, rolling that all up, and a talk around asset allocation and what that means and some of the tax considerations, validating the valuation, kind of looking at it to make sure that it works for you as the seller. And whether you're selling to family, employees, or somebody outside your business, you want it to work for you, but it also needs to work for the buyer. Those tax considerations that we talked about. The two pieces that you really need to be able to go to market. Obviously, it's a little different if you're selling to an employee, but you need a value for your business, and then you need a marketing piece. And your sell sheet is that marketing piece that will let you go to market. It's like a resume for your business. And then next step. Okay, so our opening poll, really quickly, we're going to launch the. Alrighty. It's just a quick one, talking about valuation, whether or not you've ever had a valuation done, perhaps the extent to which you understand it, and the type of legal entity. This will help Doug when Doug and Dennis, when they're talking about, just to kind of get a sense of where the audience is at. And I will share these. All right. So we have 3 folks. Okay. I'm going to give it 5 more seconds and I'm going to close the poll. All righty. And we're going to share the results. So have you had a valuation done? Everybody has said no. So this will be, I think, a really valuable experience for you to go through and figure out how we do the valuation. Obviously not applicable on whether or not you understand it. And then the types of legal entities that we have a sole proprietor, a partnership, and an S or a C Corp. Cool. All righty. So let's just take a quick review of what we talked about last time. We walked through the selling process. That is this, whoops, my guide that we the wheel that we reference often. We talked about the importance of building a team and having those key people in your corner. This is probably a once in a lifetime process that you're going to go through, and you really want those people that you can tap whenever you need them. We talked about full disclosure versus going to market confidentially and some of the pros and cons. Obviously, going to market confidentially is much less disruptive to your business, but it's harder to find buyers, right? So you're going to expect that the process will take considerably longer versus going to the market with full disclosure. And you really need to figure out what your priorities are with regards to that. And then we did just had an introduction to this concept of seller's discretionary earnings. So valuing your small business. It's worth the value of your entire business, all of the different components added up. And Doug and Dennis do a very multiple kind of complicated is probably not the right words, but a much more in-depth approach to valuation, perhaps with larger companies that are a little bit more difficult, whereas we're going to take a pretty straightforward approach to valuation that you as the seller can understand and really wrap your head around. These are the components that we're going to value. We have the goodwill, inventory, furniture, fixtures, and equipment. These other components, websites, apps, contracts, that kind of thing, and they roll up to be the whole price of your business. And it really is an art. And it's, again, you'll make some decisions based on your priorities as to where you want that value to end up. If you're anxious to sell, you're probably going to, like anything, price it accordingly. But you'll also take into consideration some of these different aspects, the trajectory of the business, profitability, like is your revenue and profitability increasing? Is it decreasing? Is it flat? That kind of thing. But we want to price it according to your priorities. If you have real estate that's part of your business, if you own the real estate where your business resides, you'll need to make some decisions around whether it's important to you that you sell them together. Are you open to selling just the business and renting to the buyer? But the point being, you would need a separate valuation for that real estate as well. So valuing the goodwill, this is that first and really kind of most challenging, because there's nothing there. There's nothing to kind of wrap your arms around. And as we said, it's kind of it's the business, right? It's your reputation, it's the brands that you have, it's your customer base, it's your profitability, it's all that kind of je ne sais quoi. But there's tremendous value in that. And that's why it's more expensive to buy a business than it is to start a business, because there is all of that. There's a proven track record. Yes. There's a customer base, there's cash flow that you kind of jump right into when you buy a business. And as we've said many times, this idea that you want to get a business that works for both you as the seller and the buyer. Our approach is this rule of thumb valuation, where we look at revenue and with a small business and what we call mainstream type businesses, it's this concept of seller's discretionary earnings. Because you could have a high top line, a high revenue line, but if you're not running your business as profitably as you might, that's where the sellers, or maybe you run your business more profitably than the revenue might show. That's where that bottom line, that seller's discretionary earnings, is a really important concept. And again, it's the best way to value the very small businesses that we're talking about here. So seller's discretionary earnings, we've talked about kind of in our first session, the concept that is the cash that a business is generating for you as the owner and for the buyer. And you may be running expenses through your business at your discretion that are not critical to the operation of the business. As in, if you didn't run those expenses through the business, it wouldn't affect the overall operation at all. And I know I, as a business owner, ran some things through my business, half of my cell phone, I ran my gas for my car, things like that, because I did run around, but it wasn't entirely. So we'll walk through some examples of those. Here's a thought for those that are not quite ready to take their business to market, is start to back that stuff out, because while you can add it back for valuation purposes, the banks don't care. They will look at your tax returns, at your P&Ls, and they don't really care if you have, even if it's properly documented, they will look at the bottom line profitability. And the higher that number is, the more likely a buyer is to be able to get traditional financing or any other financing. So just consider that as you get ready. And any SDE, any add backs to seller's discretionary earnings need to be properly documented. You need a paper trail so that you can substantiate the items that you're adding back. And we'll go through this in quite a bit of detail. So again, we've kind of walked through this, so I'm going to go through it pretty quickly. You have a P&L, just again, this idea of understanding seller's discretionary earnings. You have your P&L and you have a net profit 57.3. Then we want to kind of get to cash flow. And so we want to add back anything that is not cash based. Things like depreciation, which then increases our cash flow to 60,500. I also want to make a note here, somewhere in here. Oh, there it is. Where's my, not showing up. Your accountant will work with you at the end of the year to make some adjustments to your P&L to reduce your tax base. Say, for example, you are running your personal car through your business. Your accountant may, at the end of the year, deduct an additional amount based on that 55 cents a mile and such that will reduce your tax base, but that's not cash based. So the actual gas, right? Now I'm kind of getting into the weeds, so we'll go through that. Doug can help me with that later on too. Yeah, those adjustments. So then we talked about these add backs, right? Like if half of your car use is personal and half is business, you would add back half of your automobile expense. If $1,000 a year of your insurance expense is life insurance, your own personal life insurance, that's not business related, you would want to add that back. If your gym membership, you're running through the business, I owned a sports store, like being fit was important. Was it really critical to the business? Certainly not. And then this concept of one-time expenses. Let's say in this particular year, you spent $2,000 to develop a new website. Obviously, that's not something that you need to do every year, so you get to add that back as well. And so when we make those adjustments to our cash flow, that gets us to our seller's discretionary earnings, which is that added amount. So we get to the SDE of 65,300. So at a high level, that's what we're doing. These are some common categories where people often run expenses through their business. And, you may have somebody that plows your commercial property, but they also come and plow your house. Your internet, maybe you're running 100% of your home internet through the business because, you know, it's kind of important that you are able to tap into your system. But, you know, if you didn't, it wouldn't necessarily affect the operations of the business. So let's kind of walk through some of these examples. So, for example, when I bought Maui North, I bought the building as well. And I paid myself above market rent because it's a way to not have to pay some payroll taxes. So it kind of makes sense. It can't be like crazy, but you need to, you can adjust for that. So let's take an example here. So we have rent. The rent expense on the books is $4,000 a month, so it's $48,000 a year. Market rent, let's say, was only $3,000 a month, and that's what you would charge if you were going to rent your building to the buyer. You would only charge $3,000 a month. You add that $12,000 back, and the actual expense to the business for the purposes of valuation is $36,000 a year. And again, please ask questions. I'm trying to go through this at a reasonable pace, but I'm more than happy, because if you don't get it, somebody else probably doesn't get it either. So let's say there are two owners, or you have family. We want to make some adjustments for that. If it's a couple, let's say you have a couple that are running a business, they're both taking a salary. You can add back for the first owner. You do not get to add back for the second owner. But what you can do is, if the second owner is paying themselves $50,000, but when they sell the business, they could probably replace that person for $35,000, you get to make that adjustment, and I'll show you in just a moment. Similarly, if you are employing family members and you're paying them above market, right, that you wouldn't, to replace those people, you wouldn't need to, you get to make those adjustments as well. So here's kind of an example. Two owners, the first owner is making $50,000, you get to add that back, because then, as we've said, the number that we're trying to get to is the cash that the buyer would be able to derive from the business for their personal use, whether it's to pay debt or pay themselves, but it's the cash flow that the business is going to generate. Owner number two is also making $50,000, but it would only cost $35,000 to replace them. That's where you get to make a $15,000 adjustment. Similarly, as we discussed kind of in that example, maybe you developed a website, that's a one-time expense, it's non-recurring. Maybe you had a lawsuit and you had to settle for $5,000, right? Again, that's kind of a one-time expense. Maybe you had a huge repair that was kind of out of the blue and isn't something that you can expect to continue. The flip side is, there may also be non-recurring income that could happen. Maybe you sold off a large asset and you made $10,000. Obviously, that's not something that's going to continue either. So we need to make those adjustments. So some examples of adjustments that you are not able to make. So you, similar to me, you ran your auto expense through the business, and I would go to the bank and I had to do different things for my business. You can't add 100% of the auto expense back in, right? That would be overstating the value of the business. Similarly, maybe you run some travel through your business, but maybe it's important that you go to industry meetings or trade shows and that kind of thing. And that's critical to learning about the business or finding vendors, placing orders, that kind of thing. You can't add all of that back. And there are similar, obviously, other examples, meals and entertainment, that kind of thing. Maybe a little bit more nuanced. You took an approach to, so anybody that owns a business knows that marketing is probably one of the hardest things that you'll ever going to do with your business, because it's just so tough, right? And you took an approach and you engaged with a vendor that was going to do your online marketing, and it was a complete disaster. You don't get to add that back because you tried it, it didn't work, but kind of an example. Similarly, if you go to Rotary and you engage with clients there, some of these other kinds of. We talked about it. We're going to go through a spreadsheet here, and I'm going to share this spreadsheet with all of you, and I will be available as much or as little as you need to go through this spreadsheet. So this is what it looks like. And I'm going to stop sharing this. I'm going to share. Where is my look? I might have to bring this up. Here. There it is. Okay. So here is our spreadsheet. And I appreciate that there are folks out there that are more comfortable with spreadsheets than others. And again, I'm happy to help. But let's say these are some pretty traditional and usual types of expenses that you will have in your P&L. I have certainly seen some P&Ls that are far more comprehensive than this, and I've certainly seen P&Ls that are far less comprehensive than this. There are opportunities because what we're going to do is roll your P&L into this spreadsheet, right? And I ask that you kind of bring 2 to 3 years of P&Ls to our session today, so you can start to take a look at your own line items. I am realizing that we probably want to go back 5 years because the last 2 years have been so weird, right? And not replicable. Like, I certainly know that there are businesses that their business has been off the charts, right? And then for others, their business has tanked, right? And for some it's flat. But the idea being the pandemic has really created talk about a non-recurring situation. So I think for the purposes of valuation, it will help us to go back even deeper. But let's here's our, let's say our auto expense, let's say we're running $400 through the business. So it's $4,800 a year. And about half of that, let's say, is personal in nature. That would be $2,800. So the actual business expense is $2,400. Kind of similarly on our insurance, remember we said we had about $4,500 in insurance expense. We said about $1,000 of that is life insurance. The actual business expense is $3,500. You'll notice that I grayed out any non-cash based expenses because those don't count for our valuation. We also don't count insurance, and we obviously count payroll taxes on your payroll, but we don't include other taxes, and that's a little bit nuanced, so we can talk through that. But that will help us generate the actual business expenses for multiple years. And it may look daunting, but when I sit down either with you or you do this, it's not hopefully as daunting as it might look. Any questions as we go through there? Now I'm going to go back to here.
Kim, I'd just like to add one thing as to where you do not include the owner's compensation. You have to be careful on that because a buyer may want to buy this and do absentee management. And so they may be adding in a fair value for the owner's compensation in determining what they're willing to pay.
Absolutely. Absolutely. And it's kind of interesting when like equity partners that really just want to invest in a business that they perceive as profitable definitely don't want to operate that business. So right. Yeah, it's whereas at least in my experience and the folks that I deal with, it's generally owner operators. And But yeah, certainly if you think somebody is going to be an absentee owner and they just want a business that generates cash for them, that would need to be taken into consideration. Thanks.
Yeah, and the other point is that some buyers that do operate the business don't want to pay the value of their labor. So they may be adding back a fair value for the owner's compensation too.
Yeah, sure.
But, okay.
Cool. Yeah, thank you. So here's what I would like to do. We're going to take, 5, maybe 10 minutes, and I'd love for you, I suggested that you bring some P&Ls to our session today, kind of walk through those P&Ls and kind of go through line by line and start to consider, is a portion of that particular line item on your P&L discretionary? That is, you're running it through your business at your discretion, right? If you didn't run it through the business, it wouldn't affect the overall operations of the business. And I'd love to just get questions. And again, whether you want to send those questions to Lauren or ask them of the group publicly, like, that would be great. So I'm going to find my cell phone here. We'll do this for about 5 minutes. If we get good conversation, we can take it for a little bit longer. But take a look at those P&Ls, and as I said, start to think about those items. And I'm going to. Alrighty. So personal health insurance. That's a great question. I would say you add that back, and certainly, Doug, you can jump in here. So if you're running your personal health insurance through your business, would you consider that an add back, Doug?
It depends on what I said before, whether they're looking at it from the point of view of I want to buy this business to work in, or I'm buying this business for investment. If you're buying it for investment, then you would include the health insurance of the employee that would replace the owner. If you're doing it the way you're describing, Kim, then you would not include the health insurance.
Okay, so you would add it back. And I guess when we think about this concept of seller's discretionary earnings,
right,
as our approach to valuation, we would want to add it in.
That's right. That's one of those personal items.
Yeah.
That you would add in, but you would not add it back in for employees, just for the owner.
Yeah.
The single owner, right.
Yep. Awesome. And just kind of as we're going through this, you want to be able to defend that number. And like I had a seller who was going to sit down with, it was an employee, but you can walk through that spreadsheet with your buyer, regardless of who it is, and just explain to them, if you feel comfortable, like if you feel like you understand it well enough, you can go through and walk through how you got to that seller's discretionary earnings number. And again, this is where it's super important to be able to understand it so that you can sit down with a buyer and walk through how you get to the valuation. So it sounds like you do this exercise for each potential buyer, customizing the number as to how they run the business. I would say no. The seller goes through, so you as the seller will go through, and this is a process that you go through to value your business. Actually, Jean, that's a really good question, Jean, or whoever, it's a good question, because I think that we can make some assumptions around the type of business it is, whether it's, whoa, okay, we're at the end of our 4 minutes. If it's the type of business that somebody could invest in and not owner operate, I believe that's a choice that you would make when you were valuing the business. Would you agree, Doug?
Yes. Yeah, I guess I probably confused the person asking the question, Gene. What Kim is talking about is owner's discretionary cash flow. So that's why she is not deducting the owner's fair value of their labor. So at this point, I think follow what Kim is saying, because she's going to come up with a value for that owner's discretionary cash flow. But keep in mind, what I said is that a buyer may look at it a little differently, but this is your starting point and what you're going to ask for the business. When you get into negotiations, then the buyer is going to look at it a different way, but that's the buyer's prerogative. You don't want to feed them a different way of doing it.
Yeah.
But
and I think
they might look at it differently.
And I think in large part, the types of businesses that we're talking about are kind of mom and pop lifestyle, Main Street type of businesses that are generally not targets for equity partners. And that's basically what Doug is talking about, where somebody invests, $100,000, $500,000, whatever, in a business solely for the return that the business will generate, similar to investing in the market. Whereas the types of businesses that we're valuing here, again, are generally owner operated. So that's why we're kind of taking this seller's discretionary earnings approach.
Right. So pay attention to Kim and don't let me confuse you.
Again, there perhaps are businesses that are large enough and generate enough profitability that an equity partner might be interested in investing in. But for the large part, these are smaller types of businesses.
Right.
All righty. So here I got it. Okay. So I'm going to send that spreadsheet to you. I will share it with you, and I'll reach out to you if you would like to engage with me to help you walk through that. I can, if you feel comfortable doing it. As I've said, I'm here and available as much or as little as you need. Again, please be really realistic. The documentation is required when you're going to make those add backs for sellers' discretionary earnings. You need to be able to tie out to your taxes and show how whatever additions or adjustments you're making tie out to your taxes. And you really don't want to overstate the seller's discretionary earnings, because it could get you off on the wrong foot with a potential buyer. So as we kind of mentioned, last month, whenever it was, you come up with your seller's discretionary earnings, and then you will get an industry specific multiplier. And if you don't have a relationship with a small business development center, I would encourage you to do so, because they can get you your industry specific multipliers. But you take your seller's discretionary earnings, you take your multiplier, and that's how you get your Goodwill valuation. And very often there is a range with that multiplier. Yeah, we talked about how the fact that multipliers are based on risk. The higher the risk, the lower the value. Small businesses tend to be perceived as quite risky, so the multipliers tend to be lower than perhaps a more stable business. These are the valuation guides, and we walk through it. It gives you a description of the industry, some of the different ways to generate your Goodwill valuation. It could be a percent of sales plus the inventory. It could be the seller's discretionary earnings, which is what we've talked about. As you can see, for a bike shop, it's a low of 1.5 times SDE and a high of 2.5. Kind of just looking at some other types of businesses, here are some other multipliers that we use. And you can see it's all kinds of different numbers that you can apply these multipliers to. I really like to use revenue, because that's a number that everybody understands. It's your top line revenue, it's your gross sales. You can see it's 20% to 30, 20 to 30 for bike shops, 15 to 20 for specialty retail, 30 to 35 for florist. Each industry is very specific. And then we talked about the seller's discretionary earnings, and you can see that the multipliers range somewhat by industry. And as I said, if you don't have a relationship with an SBDC, please do, because they can get your industry specific multiplier. And if you need a referral, please let me know, and I can refer you to. I'm going to guess that Canton, SUNY Canton, is largely our service area, but it's possible that it's not. So here we get to the actual valuation, and I know this is a lot of numbers. Let me see if I can make my little pointer. How do I make it? Pen? No. Bear with me here. I'm kind of new to this. There we go. Okay. So we populated the spreadsheet that calculates the add backs to come up with your expenses. So these are the normalized expenses. So these numbers will tie back to the spreadsheet that you'll populate, where you're establishing your expenses that are critical to the operation of the business. And here we add just your top line revenue we'll probably, as I mentioned, we'll make a decision based on how far back you have your P&Ls, but the more you have, the better. Your cost of goods sold, this is something that's on your P&L, but this gets us to in this case, a 3-year average of your seller's discretionary earnings. And in this instance, it's $94,000 in change. We mentioned that we will apply the multipliers to either a top line number or the seller's discretionary earnings number. So in this instance, and in this, the best business ever, the low multiplier is 40% of sales. The high multiplier is 50% of sales. So you can see these numbers calculate. Similarly, we bring down our seller's discretionary earnings number. Our low multiplier is 2 times SDE, and our high multiplier is 3 times SDE. And then you'll make a decision around what number you actually want to use when you first go to market. And you'll notice like 188 is the low, 283 is the high, and if we look at revenue in this instance, it's pretty close. So maybe you start at the high end of the valuation and you decide that you're going to go to market asking $260,000 for your Goodwill. Similarly, and we're going to talk about this in a moment, you need to value your inventory if you have any. You may have a business that has a lot of inventory, or you may have a business that doesn't have much inventory at all. Similarly, your furniture, fixtures, and equipment, you may have high, low, etc. And then you may have real estate that you want to add in, and we'll talk about how you do that. So the total valuation of this business, including the real estate, is $656,650. And where's my old down there? Okay, so what about the assets? So the inventory, furniture, fixtures, and equipment. Let's do our little asset poll here. Okay, so regarding the assets of my business, FF&E, so furniture, fixtures, and equipment will be a large part of my valuation. Inventory will be a large part of my valuation, or I have no idea whether FF&E and inventory will be a large part of my valuation. So if you guys would, I can launch it. You guys want to just kind of let us know if you think if you have a business that has a lot of inventory, maybe you have a business that doesn't have a lot of inventory. Maybe at this point you're not really sure because you don't know if where those valuations are going to come in. Give it 5 more seconds. Cool. All right, we're going to share the results. Looks like one individual has FF&E that's going to be high, one individual has inventory, and a couple of folks that aren't really sure at this point. And so that is again why we are here learning about this process. So thanks for participating. Oh, Yeah, I did show up. Okay. That up. Okay, let me back over here. Okay, so now we're going to talk about inventory. We walked through the Goodwill valuation. Let's talk about valuing inventory. And for those that don't have a lot of inventory, just kind of bear with me for a little bit. Inventory is obviously a current asset. It's anything that you resale to produce revenue. And depending upon the kind of business that you have, a retail business is largely going to sell just finished products that they have purchased. If you're manufacturing, you're going to have inventory that are at various points along the way, and all of that does need to be valued. As I mentioned, inventory could be a large part of your purchase price. It may be a very small part of if you're more of a service-oriented type business, inventory, you won't have much inventory. Some of the inventory may be, depending upon the type of business that you have, could be dated or obsolete, in which case it doesn't have the same amount of value on the open market, or what we call fair market value, than it has perhaps on your books. And so I am a case in point where I overpaid for inventory when I bought my business, and I will forever like whap myself upside the head because you think you're all smart and everything, but I way overpaid for my inventory. So it may be, if inventory is a big part of the purchase price, you may need to do a physical count. Like I know I would have to do inventory at my year end every year, total pain in the neck, but we had to do it. You may need to do that when you go to close. Or it could be that through the negotiation with your buyer, you determine that you're going to assign a value to the inventory, and it's going to be that value regardless. So for example, maybe you have $180,000 worth of inventory. You negotiate to value that inventory at $120,000. And you just need to make sure that your value on the books doesn't go below $120,000. Or it may be more involved than that. And there are, again, it's all negotiated in the contract. If you have certain items, and this is true for both inventory and FF&E, you may need an outside consult to help you establish that value. And If you've had a business that's operated for a long time and you have a lot of inventory, it may throw off the value of the business because over the years, you've built up this huge inventory that may not actually be necessary to run the business and may not allow the valuation to validate, in which case you may need to actually sell off some of that inventory before you actually sell the business because it's too much inventory. I had a shop that had about $1 million in inventory, generating like $1 million in revenue, and that doesn't work. So
You also have to watch out for old and obsolete inventory that basically nobody will buy.
exactly, and that's where exactly, because if it hasn't sold in 5 years, it's absolutely not selling for full market for whatever retail is, right?
Right.
You could, if you have enough detail, it's possible that you could come up with kind of an approach to valuing. I had a bike shop and I was working with a bike shop, and it could be that you assign a value. You have bikes that are less than a year old, and you're going to value those at 95% of what's on the books. Maybe you have bikes that are a little bit older, and you're going to assign a slightly lower value to those bikes. You might have apparel, all of the apparel, you're only going to assign to 70%, similar. And you would obviously need a certain level of inventory detail in order to be able to do that. But it's an approach, and it may be that you negotiate to that approach with your buyer, and then you have to do a physical inventory when you close. Pretty complicated. It's like everything, you can take a complicated or not a complicated approach. So furniture, fixtures, and equipment. So this is everything that you use in the course of running your business to produce income. And so it's not only office equipment and point of sale systems, but like me, I had a pretty comprehensive or expansive rental inventory that I would lease out and rent throughout the course of running business. That was also considered part of my furniture, fixtures, and equipment. If you run a canoe operation, those canoes and life jackets and paddles, and in addition to the office equipment and that kind of thing, that is all considered furniture, fixtures, and equipment. If you are a business, perhaps you have a landscaping business or other type of operation that has a lot of heavy machinery, that would also be considered furniture, fixtures, and equipment. And the book value, the value that is on your balance sheet and or your tax return, may have no bearing whatsoever on the value, on the fair market value. Depending upon how you and your accountant have decided to depreciate that particular item, it may be on the books for nothing when in fact it still has a lot of life and is critical to the operation of the business. And how critical it is to running the business has a bearing on the value. So if you can't run the business without it, you can probably get more money than office furniture, right? That you could put boxes together and it's not such a big deal. Sometimes, similar to the inventory, you will need to get an outside consult to do an appraiser. So again, a ski, bike, and board business, a ski tuner that was originally $55,000, it's 25 years old, maybe you can get 10 grand for it. But let's say that you recently, within the last 5 years, bought a $250,000 ski tuner. The value on the books is $100,000. And maybe you have somebody come in from your vendor and they say, yeah, it is actually worth $100,000, or maybe it's worth $150,000. But you may want to take that approach in terms of valuing your furniture, fixtures, and equipment. Similarly, office furniture, and I will tell you, it's all over the map. Restaurants, you're not going to get a lot of money for your furniture, fixtures, and equipment, like cents on the dollar. 10, 15% of original purchase price is not uncommon. So and again, it's all points that will be negotiated. In a moment, Doug will talk about the tax implications and the asset allocation and how much you assign as the seller to inventory versus furniture, fixtures, and equipment versus some of the other components that a buyer will pay for. I have a furniture, fixtures, and equipment email worksheet that I can email you that will help you walk through some of this stuff. This is kind of like you may have a comprehensive front-end e-commerce website that was $50,000 to develop. You would certainly want to make sure that that gets valued and added to your valuation, and the other things that may add to the value of your business. Real estate, we've talked about this, the fact that you need to make some decisions around whether it's important to you that you sell your business with the real estate. I have sellers that will not sell the business without the real estate. It's important to them for whatever reason. Maybe they need the cash. I don't know. Maybe that's your ideally you would sell the business with the real estate, but you're open to whatever, right? You would lease the buildings back to the buyer. Maybe they can't afford the building out of the gate, but they want first right refusal if you decide to sell. Again, just these are the things that you'll want to consider as you decide what to do. So in some instances, let's say sometimes motels, campgrounds, that kind of thing, the value of the real estate basically is the value of the business. There's very little goodwill. And you can see sometimes there are purpose-built real estate where really you can't really do anything else with it, right? Because it's so specific to the needs of that business. You still need to make sure that it cash flows. And we'll go through a couple of examples here, but let's say you have $1 million property that's generating $100,000 in seller's discretionary earnings. We're always going to assume a 20% down payment, right? So that means you're going to have to finance $800,000. 20 years and 5% are pretty normal terms for real estate. So that's going to mean that you have a $5,279 debt payment per month, $63,000 a year for debt service. And so on that $100,000 of seller's discretionary earnings, that sounded pretty good, it actually leaves you with only $36,000. And that would be a decision that you would need to make. Can you go to market with that? So one example. What do we have? You will come up with a range. So we have our low end valuation, high end valuation on the different components, and we can walk through. As we said, your goodwill, you could have a range because we have that FDE times the multiplier, and you're going to have, generally speaking, a high and a low multiplier. Your inventory, maybe at the high end of the range, it could be worth $460,000. You would never go below $280,000. Furniture, fixtures, and equipment. In this case, pretty low, but the low end or the high end and the low end, it all gets you to a range. Okay. So we tie all the high numbers. We tie all the high numbers together. We come to 852,000. If we do all the low end numbers, we get to 471,000 and change. And now we just want to go through and make sure that this number could work for a potential buyer. And we're going to make some assumptions here. We're going to assume that it is owner operated. We are going to assume a 20% down payment, because if your buyer is going to get financing, by and large, they will need at least 20% down. I know there are instances where that number could be lower, there could be some equity, but again, for the purposes of our exercise, we're going to assume 20% down. Oh, just really quickly, liabilities. With our types of businesses, mom and pop type businesses, generally speaking, liabilities will be taken care of at the close. If there are small outstanding debts, those debts would be paid off with the proceeds of the sale, but sometimes they aren't. And you need to deduct those liabilities from the valuation. And these are some examples of liabilities that would be deducted. This concept of unearned revenue is a little bit tougher, so let's just go through a couple of examples. So let's say you have service contracts. Your business it's a pest control business, and it's $1,200 a year for you to have pest control. You have 30 contracts with customers for that. They've paid you the $1,200 a year. $1,200. You're 6 months into the contract. So you have 50%, right? You're only halfway through a contract that a customer has paid for. You need to compensate the buyer for that because they're going to have to deliver those services, but they won't get that revenue. Similarly, layaways in a retail environment, maybe you've sold a $1,000 canoe, you received a 50% deposit. The new owner is going to actually have to buy, let's say it's on back order. The new owner is going to have to buy and deliver that canoe. You would deduct that $500. And if that you have that in situation times 10, it would be $5,000. Just again, some nuances with valuation. So we have a range. Let's talk about validating that valuation. And then we'll get through this and we'll take a quick break and then we'll bring Doug and Dennis in. So let's just circle back to paint a picture about our buyer. The buyers of small businesses, you may or may not remember from our first presentation, 54% of buyers earn less than 100,000, right? 19% of that 54 earn less than 50,000. Only 8% of buyers, and this is according to Biz Buy Sell, an online marketing organization, only 8% of buyers earn more than $250,000. So these are not people that are rolling in money, right? I imagine that they've spent a long time to squirrel away whatever their down payment is going to be. That is the person that is likely going to buy your business. So let's just take a look and see if that the way that the business is valued works for you as the seller. The buyer needs to be able to make the debt service because they are more than likely going to have to take out debt. Obviously, they need to pay themselves, and then they want to be able to reinvest in the business, right? To be able to build the business. So we have our high-end valuation, right? $852,000. Let's see if that works. So financing on $852,000, as I mentioned, we're going to make some assumptions around the down payment and the terms. We're going to assume a 20% down payment. So they're going to need to come up with $170,000 in a down payment. It means they're going to finance $682,000, right? And that's a big number, right? So you could cut these numbers in half and make it relevant. We're going to assume 6% over 7 years. The financing will often be broken down and inventory will be financed differently than Goodwill. We're just making some broad brush assumptions around the total debt. So that means you're going to have debt service of almost $120,000. Now let's look at the cash flow of the business that is being purchased, right? The seller's discretionary earnings before the debt service is $137,000, right? Let's bring in that debt service of $119,000, right? It only leaves the buyer with $17,000 in change, right? Like, obviously it's up to the buyer to go through this. You as the seller don't need to go through this, but if you want to go to market with that number, just be prepared that you're going to need to wait and wait and wait. And like, certainly I have heard of the, Wall Street parent that bought a business for their college graduate because they wanted them to have something to do and they have that kind of money. But again, by and large, that will not be the case. So that there's that 100. Again, kind of, we understand what we're looking at here. So what if we were to go through and look at the low end valuation and we go through that same exercise? 471,000, we're down payment of 94,000, we're financing 377,000, annual debt service of 66,000. It's leaving the buyer with 71,000. So that makes more sense, right? And again, these are just things that we can go through to help you determine a value for your business. And again, it kind of gets back to priorities and do you want to be priced to sell because you're really ready to move along? Or are you just testing the waters and seeing what's out there, in which case you can start at a higher valuation. Yeah, so everything is going to be negotiated, and the different asset allocation and that kind of thing. is we're going to take a quick 5-minute break here. And wow, 9:02, so I'm not doing too bad on my break. Let's take a 5-minute break, and then Doug and Dennis are going to talk about some of the tax implications of selling your business and what works for the seller may not work for the buyer and that kind of thing. But it's really important to understand this stuff and then have a conversation with your accountant. So I'm going to start a timer and go spruce up your coffee or do whatever it is you need to do. And we'll see you back in 5 minutes at, what do we say, 9:08. Okay. I'm going to stop sharing here. Oh, I'm not sharing. So Doug, I think you can share. There you go. Okay, I'm going for coffee. Bertie, we have about 30 seconds left. And we will get rolling again. And my fresh cup of coffee. Okay, sorry. So it sounds like there's everything. Once you have all the tools needed to provide service, not drastically. All the tools to provide service. Justin, I don't know if you want to unmute yourself. Oh God, there it goes again. I am not following your question. And it's, if you want to send either Lauren or me a chat, that works, or if you want to unmute yourself, I'm just not sure what you're asking. And we can certainly take it offline as well.
Kim, also, I want to point out that the last slides that you had shown on how the discretionary cash flow to the buyer after the financing wrapped into my point was that people are going to be looking at that as to how much they can make after the financing for running that business. So what you did is you built it in on the back end, what I was discussing before. And I just wanted to bring that point home for people that might have been confused by my comments.
Okay, cool.
Okay. That's exactly what I was getting to, is that a buyer doesn't generally want to pay for their services and working in that business. And so, and they are going to be looking at financing, and the financing has to leave enough money on the table to feed their family after they buy it.
Yeah, exactly. Exactly. Cool.
And you made that point very good at the end.
Thank you. We're trying.
Yeah, Kim, my experience has been on the buying end a lot more than the selling end from the financial aspect. And I think that last slide is generally the exercise when you're making a decision to buy a business. That's really the important exercise. And there are some things that can happen as a buyer, things that you want to consider other than that bottom line. And I only say this as sellers, you can make this point. So if there's a strategic alliance that you are going to save, like the buyer may be able to save some of those administrative costs or those fixed costs, almost like a joint venture, those things can affect how much a seller is willing to look at that bottom line. Sometimes we've seen fruitfulness in marketing your business to competition. So sometimes those are things that are all going to affect that. It isn't all about that bottom line, is what I'm saying, because those decisions on the buying end of it, there's a lot of factors that go in there.
Absolutely.
But it's important to understand it as a seller, is what I'm really trying to say.
Yeah.
And we got a question. So why can't the term be extended, the term of the loan? So that's a great point. And we'll talk about this in our next session where we talk about financing options and what it looks like. So real estate, 15 to 20 years is pretty normal. Furniture, fixtures, and equipment inventory, 5 to 7 years is pretty normal. Probably not going to get longer than that. The goodwill is the wild card, right? Because by and large, the owner will have to finance the goodwill. If you have a buyer with phenomenal credit, they may be able to get a lending institution to finance that, but it would still be a maximum of 5 years, right? If an owner is willing to extend credit and be the bank for the goodwill, then it's up to the seller to determine. It's all negotiated, right? Because if it doesn't cash flow at 5 years, but you as the seller are willing to extend that loan out to 10 years, obviously that's much riskier for you as the seller. But if getting top dollar is important to you and you're willing to hold paper for that long, that's a choice that you'll make. And we'll get into this in more depth in our next session. But yeah, the term matters tremendously.
Yeah. Okay. Are you ready for us to get going here?
That would be great.
Okay, let me get the slideshow up on the screen. Hang on, I think I have to get rid of that. There we go.
Good morning, everybody. Thanks for attending, and thanks for Kim and Anka for allowing Doug and I to participate. My name is Dennis Vacencio. I am an accountant and business coach with the Hoffman Eels Group CFO to Grow. I have 35 years experience, mostly in small businesses from the financial end of it as a controller and CFO. Doug Hoffman is a CPA, former managing partner with the firm. He's got 48 years of experience as a CPA, MBA, and certified business coach, in addition to owning and running multiple businesses over the course of those 48 years. So we're going to talk about the tax considerations or tax strategies when we talk about selling the business. To defer or eliminate taxes if possible. Section 1031 exchanges for real estate. Charitable remainder trusts, which Doug will jump into all these a little deeper as we go along. ESOPs and an installment sale. Sub-S corporations, 5 years to eliminate any buildup of gains of a C Corp. And then the step-up basis. Under tax considerations, you want to make sure that you understand the impact before setting the sale price. It's imperative that you know the net cash after taxes. Taxes can affect those numbers that Kim was talking about dramatically.
Okay, so let's dive a little deeper here, talking about considerations in selling. Everybody wants to pay the least amount of taxes. As Dennis said, you want to make sure that before you go out on the market that you calculate what taxes are going to be due, because that's going to be very important to fit into your personal financial planning goals as to whether you're looking for retirement money or for investments for a new venture or whatever. Money talks and show me the money, but you want to make sure that all the money is going to be there to fit your plans, and how much Uncle Sam in Albany is going to get is going to have a big impact. So your goal is to defer or eliminate taxes, or at least minimize the taxes. And there's several ways of deferring and eliminating taxes. Section 1031 is a like-kind exchange. You can only do that now with the new tax laws with real estate. We were able to do that with other assets before, but the new tax laws only allow like-kind exchange with real estate. So if you have real estate involved in your sale, if you follow the rules correctly, you can exchange for another piece of real estate, either investment or commercial real estate. You can't buy a new home with it because you can't use it personally for at least 3 years. So that's one way of deferring taxes. Charitable remainder trust is pretty complicated. We don't have enough time to get into the details there. But if you put your assets or your business into a trust, there's a way to completely eliminate taxes and live off the proceeds. You would pay taxes as you lived off the proceeds, but you wouldn't pay taxes on the sale. ESOP is probably one of the best, but more complicated ways of minimizing your taxes. That's where you sell the business to the employees and the employees bootstrap that, similar to what Kim was showing in the last few slides. They go out and finance the business. ESOPs, the benefits of the ESOPs is that in some cases you can do a tax-free swap for US equity stocks on the stock market, and the business can deduct the loan payments, both principal and interest, as a business deduction for their taxes. Like I said, that's one of the best going, but probably one of the most complicated ways of selling your business. Installment sale, in some cases you get to defer the taxes over the life of the principal payments, and that is a way to get into lower tax brackets and receive money or pay the taxes as you receive the money.
Doug, what is an installment sale?
Installment sale is where the seller holds the note that Kim was talking about. You would collect interest and principal over the period of that note for the financing that you do. The IRS allows, and I'll explain when you can't do it, but in most cases you can defer the taxes as you collect the money. Pay taxes each year on the interest and the principal. Sub-S corporation is a way to minimize taxes, because if you sell assets of a C corporation, you're going to have a double tax where the corporation pays the tax, and then to get the money out of the corporation, you're going to pay a second layer of taxes. So a C corporation has that double tax whammy. In order to eliminate that, there's a 5 years to eliminate the built-in gains. And when you switch from a C Corp to an S Corp. Again, I'm not getting into the details here. I'm just giving you a big a brush view of what the tax consequences are. And here's a way that we can eliminate taxes for everybody. There's only one caveat to it. You have to die. But if you die owning assets, including a business, in some cases, you get a step-up basis to fair market value on death. So your heirs would not necessarily pay taxes. And that's pretty important to think about in some cases. I had a new client that came in yesterday that was 93 years old that was selling his business. And this is something he may want to consider. And it's kind of gruesome, but it's part of life and death to think about. Okay, so let's so the tax considerations that you want is it all cash or partial cash sales where you hold the installments sale note and collect that. You have like-kind exchanges on real estate. You have charitable remainder trust. So now let's jump into capital gains versus ordinary income. You're going to have different tax considerations on each of these assets that Kim was talking about. Furniture and fixtures, buildings, goodwill, covenant not to compete, and depreciation recapture are things that sellers have to consider as they allocate the purchase price, as Kim was showing you on how you come up with your valuation. But once you come up with that valuation and you start getting into a purchase contract with a buyer, you're going to have conflicts of interest between the buyer and seller on that allocation of the purchase price. So as a seller, you're going to be concerned about capital gains versus ordinary income tax. The purchaser and the seller are going to have different consequences on each of those categories. So let's quickly go through that. And
And
again,
Joe, do you want capital gains or do you want ordinary income?
you want capital gains as a seller. But what gives you capital gains may not give the purchaser the depreciation schedules that they want. So we're going to take a look at that and show the conflict between the buyers and sellers in the next slide. But we keep telling you, remember, I can't tell you how many clients, even though we preach this, will come in and say, I sold my business. And you go, well, why didn't you tell me before you got into a purchase contract? I could have saved you tremendous amount of money. So we're going to keep preaching that because people will get so excited about selling their business that they'll forget to see their tax account.
So
Yeah.
Doug, in Kim's model where she goes through and does the business valuation, you're saying that when you do the purchase agreement, you can allocate that price amongst those categories that you had in the previous slide. Is that correct?
That's correct, but you don't necessarily have to follow the way you came up with the business valuation. Right. Although you have to be careful because the IRS is going to want a reasonable allocation. You can't just pluck a number and say, that's what I want Goodwill to be, or pluck a number and say that, I'm going to sell the capital gain items for twice their value. There has to be substantiation behind it, but as Kim was showing you, there's a range in every single item. And so that range can help or hurt you tax-wise. And I'm going to show you where the seller is thinking from and where the buyer's thinking from. And more likely, you're going to have to negotiate in the middle, or if one party has more leverage than the other, you're going to have to go with that negotiation if you want to sell your business. So let's take a quick look at the chart that we have in the next slide. And we're going to show you the conflict between the buyer and the seller and why you're going to come up with a negotiated value here. So let's start with furniture, fixtures, and equipment. I don't have in here inventory, but normally a buyer's not going to pay more than your cost basis of the inventory. If they do, God bless them, bless you, and take it and run. But normally you're not going to have a gain on your inventory because the buyer's going to pay somewhere at cost or below cost. As Kim was showing, in some cases you have to do 90, 70% of the old and obsolete inventory. So you're going to get probably less than your cost basis when you're done selling your inventory. And that may come out to be a loss. So we don't even have that on this chart. But furniture, fixtures, and equipment, let's start with that. OT means ordinary tax and CG means capital gains tax. So furniture and fixtures for the seller has, first of all, depreciation recapture, which is at ordinary tax rates. So if you bought something for $100 and you depreciated it all the way down to zero, and you sold it for $80, you're going to have $80 of depreciation recapture. Point furniture and fixtures and equipment, there's no installment sale allowed in that. So if you finance that over 5 years, you're going to have $80 worth of income in the year of sale. Now, there is capital gains involved in excess of costs. And you say, well, who's going to sell equipment for more than what they bought it for? Well, first of all, if you bought a bulldozer 20 years ago, you'd be surprised. It'll sell for more than you paid for it. And used cars now, people are starting to get gains on used cars that they bought 2 or 3 years ago because used cars during the pandemic went up 30% in value. So
Hey, Doug, really quickly, I'm sorry. I'm like, what is depreciation recapture? I should probably know this, but I don't.
Okay. Well, like I said, if you bought something for $100 and you took $100 in depreciation,
Yep.
and then you sold that for $80. $80 is the depreciation recapture.
So you have to pay ordinary tax on that $80? Okay.
Right.
Got it.
Now, if you sold it for 110, then you have $100 in depreciation recapture, and then you have $10 in capital gains.
Okay. Okay. Thank you.
So that's just something to think about. The buyer is going to look at it a little differently. They're going to, that's the fastest they can write off an asset that they're buying. And so they're going to look at it from the point of view, I want to pay as much for that furniture and fixtures as the fair market value will allow me to. But they're also going to have sales tax due on that sale. So it depends on the cash flow of the buyer. Sometimes they want to be aggressive and pay as much as they can for that, so they can write it off real quick. But then they don't want to open up their pocket and pay the 8%.
Yeah.
So they're going to go either way, depending on the how deep their pockets are, and how much they need those deductions in the first couple of years. So that's the negotiation that you get between the buyer and seller on furniture and fixtures. Now let's look at land and building. You do have depreciation recapture on buildings. Land, you normally can't depreciate except for land improvements like sidewalks and things like that. But land is no depreciations allowed on that. So in the allocation of the purchase price, the buyer is going to want very little allocated to land because you can't depreciate it, he or she. But the seller, once they get beyond depreciation capture, they don't care because land and building will be capital gains. Now, the depreciation recapture on buildings is more forgiving than furniture fixtures, because it's what they call 1250 depreciation recapture, which has a maximum of 25% tax. So if you're in a year of sale, you're going to be in the upper brackets more than likely with all the sale amounts. So the 25% recapture is a lot less than the ordinary income tax that you might pay on furniture and fixtures. So the allocation to the land and building, first of all, the maximum you're going to pay is 25%. Then you get into capital gains rates. Capital gains rates go from anywhere from 0 to 10% to 15% to 20%. And then if you get above 250,000 in total income per year for married individuals, you get into an extra 4% tax, which is the Affordable Care Act kicking in at that point with a special tax over and above that. But let me qualify that. That only applies to buildings that aren't used in your business. So if you're selling a building that has like a plaza that has many units in it, the unit that your business is in doesn't get that extra 4% tax. But the other units would, because that's real estate not related to your business. Complications, but that's the IRS, if, and, or but. Okay, so that's what the seller's worried about. The buyer is looking at it from the point of view that if it's residential buildings that they're buying, they get 27 years depreciation. If it's commercial, it's 39 years. And again, land has no depreciation. So they're going to want to keep the land value low. They're going to want to allocate the purchase if there's residential apartments in the building, et cetera. They're going to want to allocate more to that and less to the commercial side. So that's what the buyer's thinking about. Goodwill, buyers like Goodwill because they get to write that off over 15 years. So they're going to want to allocate a lot to that. but they're going to be constrained on the building side. So if you sell a building for $200,000 and you have $50,000 in goodwill, buyer's going to want to allocate it that way. But when they go to get the loan, as Kim was saying, banks don't like to finance goodwill. So they may only give the buyer 70 or 80% of the building allocation and nothing for the goodwill. So a bootstrap buyer may not be able to finance the goodwill that way. So they're going to play between wanting 15 years depreciation compared to 39 years against what financing that they have to get. And so from your point of view, the seller, it doesn't matter, because once you get the depreciation recapture, you're in the capital gains. So from your point of view, it doesn't really matter. And it'll be up to the buyer to decide from their financing how much they're going to allocate to the building and how much to the goodwill. And of course, what they allocate to the building has to then go through an appraisal, and the appraisal for the bank has to justify the value there. So you see the limitations that you have as you're playing around with this and negotiating. Now, covenant not to compete, that's a portion of goodwill that makes sure that you're not going to open up a shop down the street and compete against this new buyer. And so you're always going to have some type of covenant not to compete in there. But as a seller, you want that to be as low as possible, because that's taxed at ordinary tax rates. And so the buyer will have to amortize that over 15 years. But under law, a covenant not compete can't really bind you for more than 2 to 5 years, depending on what lawyer you're talking about. and so, the covenant not to compete is something the buyer doesn't want high either, because they have to write that off over 15 years. So you're kind of in mutual territory there. They probably won't give you that much for it, and you don't want that much for it. But they want you legally bound not to compete. So something will be in there. And depreciation recapture, I talked about again, is that's again, whatever depreciation you took in the past on your cost basis comes down to your tax basis when you sold that. So if you bought it for $100 and you depreciated it for 50, and your tax basis is 50. If you sold it for $80, then you have a $30 gain, and that's $30 is your recapture in this example. And if it's on buildings, it's maximum of 25%. Again, depending on the sale, you could get some of the depreciation recapture on buildings at the lower capital gains rates, lower than the 25%. But that all depends on where your brackets are falling on your tax return as to where you're going to hit on that. And it's always ordinary taxable income on furniture and fixtures. So I hope that gives you a little bit of insight. You can see that there is different motivation for the buyers and different motivation for the sellers, and that's why you get into an arm wrestling match. And if you have equal leverage in the sale, then you're going to meet somewhere in the middle, where somebody told me once the perfect business deal is where both the buyer and seller feel that they didn't get taken advantage of, but they paid too much or too little, depending on what side you're on.
Yeah, thank you, Doug and Dennis. And if that wasn't an advertisement to get with your accountant, I'm not sure what is, right?
Well,
Right.
yeah, don't laugh though. I had somebody come in yesterday that signed a contract in October, and their advisor said, "See your accountant, see your accountant." And here it is 2 months later, and they weren't my accountant, or they weren't my client. But I'm going, why did you get into a contract without seeing your accountant?
Yeah, yeah. And I know, you know, accountants bill at a certain rate an hour, but it's worth every penny. And just because the tax implications of just moving those levers on FF&E versus, you know, the covenant not to compete versus Goodwill, it can have tens of thousands of dollars worth of tax implications. So definitely get with your accountant out of the gate, and understand the different pieces. So thank you again. And if you guys wouldn't mind just giving me back control, that would be awesome.
Okay.
Stop sharing or whatever it is you do. There we go. And again, like any questions, please feel free to put them in the chat, and we will take it. Whoops, I gotta go back up. Sorry, gotta go back to my. Bear with me here, folks. Sorry, I had to go make a quick change. Alrighty. Go from here. Alrighty. Thank you, Doug and Dennis. Really appreciate it. It's complicated, and you help make it a little bit less complicated, but again, reinforce the need to get with your accountant.
Okay, glad to do it, Kim.
Yeah. So the idea is that you've created a value for your business, a starting point from which you want to go to market. The next piece that you want to have is that sell sheet, which is basically a resume for your business. And I was realizing that as business owners, you probably haven't had to use a resume for quite some time. A resume is not a summary of every job you've ever had and every job responsibility you've ever had. It's a succinct, tight representation of all of your best assets and capabilities and such. And a sell sheet is a similar thing. It is the foundation of your marketing. You want to put your best foot forward and use it to create interest on the part of a buyer. As we talked about in our last session, very often a buyer isn't 100% clear on the type of business, the industry. They just want a business that they feel good about. And so bear that in mind. We talked about the fact that 30% of businesses actually sell, and having a great sell sheet that really puts your best foot forward will certainly help the likelihood. And one thing that was really kind of fun with a session that I did last year is somebody said, wow, now I feel confident to go into the market with my business, right? Like before this, I didn't really know how to do it. And this is between the valuation and the sell sheet. I now feel really, really good about this. Okay, yeah, we talked about this. You want to inspire a buyer to contact you. There's a ton of information, and you're going to want to make some decisions around the information that you want to include. And your decision around confidentiality and anonymity will bear into the information that you put in your sell sheet and that you share, whether it's sharing locally or sharing on some national websites that we'll talk about in our next session. So here is kind of a structure of a sell sheet. You can use this, or I've seen sellers that take this information and use Canva and put a really nice, slick marketing piece together. Whatever, this is the information that you want. So your headline. A good portion of the marketing that you will do for your business will be online. And very often you have an opportunity to include a headline. You want it catchy, you want it to showcase and catch somebody's attention in a couple of words. So here are some examples of, so-so headlines. It's a 15-room motel in the Adirondacks versus a growing Adirondack motel with high profitability and expansion opportunities. So you want to paint a picture in that first headline that entices somebody to click on your listing, right? It's always just getting somebody to the next level. Do we have some more chats here? Oh, Canva, awesome. Yeah, Canva's awesome for anybody that isn't familiar with it. Again, turnkey, established. These are the kinds of words that you want to include to, again, entice someone to click. Often you'll have a tagline, which is kind of similar. It's that next level of detail where you can provide a little bit more information. Again, this idea of enticing somebody. Rapidly growing, year-round. And again, these are just some examples of words that you can use and language that will entice somebody to continue to pursue your business. The location. So, as we know, 2/3 of business buyers will be outside your area. You want to include the location. If your business is a one-of-a-kind business in a particular town, you may just list the county, because that will allow a buyer to hone in, but not, maybe there's one Vietnamese restaurant in Canton. And if you say you're a Vietnamese restaurant in Canton, obviously it would, people would know, and the cat would be out of the bag, or whatever it is. So business description, again, highlighting your uniqueness, showcasing your positive trends in margins or downward trends in expenses. This is all fairly straightforward stuff. I am more than happy to work with you on this. You can put your draft sell sheet together and we can work together on it. Talking about your legal entity, that kind of thing. How long you've been in business. Again, just type. These are some great words. Just some examples of great words that you can use. Loyal staff, loyal clients, strong social media, strong earnings, strong reputation. Again, kind of fairly common sense kinds of things. But at the same time, sometimes it gets lost in things. The financials. This is a decision that you will need to make. Some people go to market full disclosure on the financials. More often than not, people will have an asking price and they might include some other, again, that's a decision that you can make. So the key financials that you're going to want to include were showcased on that list. So when you think about your financials and kind of your valuation, you want to be very clear in your head what your starting place is, your best case scenario, and then your walkaway scenario. This is kind of the basics of negotiation, but leave some room when you go to market with your business around those items. Another, if you are considering offering seller financing, which most sellers do, be clear on how much you need as a down payment. And you'll want to showcase that, because that's, maybe you need $100,000 down payment and you're willing to hold paper on the rest, but just being clear on those items. Your asking price, it's your total valuation, start about 10% higher. This is kind of things that we've reiterated a couple of times. So these are our listings from Biz Buy Sell, and there's some different ways that sellers have offered seller financing. So here's a business that is for sale in Suffolk County, New York. They want $249,000 down, and they're willing to finance $100,000 for 4 years at 6%. Here's another one, a business for sale. They want $75,000 down, $125,000. Yeah, you can read these. They want and we talked about this the last time, and we'll talk about it more when we go talk about marketing more, but just vetting your buyer and making sure that they are qualified to be able to buy your business. In this instance, they want $399 down. They're willing to offer seller financing to a qualified buyer. Revenue. So how you describe your revenue in your sales sheet is up to you. If it's flat, you can use a 3-year average. If your numbers are increasing, you want to show that, right? Like, so you want to show your individual revenues over the last several years so that a buyer can see that your revenue or your profitability, those kinds of things, have been increasing. If your revenue is, or profitability is decreasing, there are a couple of ways that you can do it. Just listing your most recent revenue, using kind of vague language. Obviously, you'll need to disclose this, but the idea is just to generate interest in your business in a way that gets them to the next level. Cash flow, we've talked about that. That's your seller's discretionary earnings. You can make a decision about whether or not you want to include that. Furniture, fixtures, and equipment, you can include that or not include that, and we'll show how your listing, you may call it out separately, you may weave it into the selling price. The same is true with, I think we're clear on what FF&E is. Your inventory, similarly, it's the stuff you sell. And whether or not you include it in your asking price or you have a separate line item in your listing is up to you. So if we have, so here are a couple of examples. We have an asking price of $525,000. The FF&E is $60,000. Inventory is $65,000. And in this instance, the inventory is not included in the asking price, but the FF&E is included in the asking price. And there are, I'm sure, tax reasons why it's done this way, but just again, a couple of examples of how this is done. Similarly, $500,000, 35 and 250 on the inventory, and you can see sometimes it's included, sometimes it's not. And I thought this posting was pretty good, and we'll talk about it when we talk about growth and expansion. Actually, we'll save it for that one. Real estate, you know, we've talked about whether or not you want to list your business with or without the real estate. Here are two interesting listings. The same business listed twice. The first time the asking price is $749,000 and change. You can see the business value is $150,000 and the rest is real estate. Okay, here is that same business listing, right? The business only is at $150,000 and property available if desired, and talks about what that valuation is. So you can make some decisions around how you want to list your business. And again, we can talk through that if you'd like. Employee information, pretty straightforward, just talking about maybe you have a super loyal employee with a high tenure, how you use 1099s versus employed. You could talk about your org chart. You can, you know, maybe you have critical skills that are imperative to running your business, just talking about your employees. Your facilities, just be detailed about your facilities. If you rent, you might want to include information about whether or not your lease is assumable or transferable, things like that. Competition, you definitely want to address whether or not you have competition, where your ranking is in that competition. Is the internet a competitor to you? Just going into details on competition. Yeah, so here, Weathersby Guild is the #1 repair and restoration national choice. Here are just some examples of how a business has listed their, whether or not they have competition or not. So growth and expansion opportunities. So my analogy to this, when you buy a house, or if you're like me, you go in and you're like, this will work, but I'm going to do this and this and this and this and this to the house to make it my own, right? I'm going to paint or change this, change that. And when you actually get there, you may do some of it, none of it, whatever, but you have these ideas. Similarly, with a business, a buyer is going to think that they are going to capitalize on every growth and expansion opportunity that is there. And so showcasing those opportunities for a buyer is super important. And even monetizing how, if they were to offer a particular service, how it might actually generate revenue and profit for them. And we'll talk about a business plan in our next session and how important that is to financing and such. But so here is that posting that I had shared. So currently selling bridal gowns, only new owner could expand to mother of the bride or bridesmaids should they want to grow the business. It's been thriving. Evening hours might also open the option for expanded customer base. I thought that was a great way just to showcase opportunities to grow revenue and profitability. So I thought that. So when part of the reason why somebody buys a going concern that is an existing business versus starting their own is because it's an existing business. And the kind of support that you're going to provide to the buyer is definitely included and potentially negotiated. The time frame, whether it's in person or remote, and think about what kind of support you want to provide to a buyer and whether or not you're going to be paid for that. Again, it's all negotiated. As we mentioned, 2/3 of buyers are from outside the area. So sell your area, right? We all have, particularly up here, like we have awesome opportunities and great things. And then the contact information. If you are going to market confidentially, you may want to set up a separate email address and or phone so that a buyer can get in touch without knowing what the business is. So make some decisions around that, but encourage somebody to contact you. And include pictures, right? Like a picture is worth 1,000 words. If you're marketing confidentially, you'll want to do that in a way that doesn't disclose the identity of the. So, I think we've looked at a bunch of these. If you go to Biz Buy Sell, there's some great examples out there. Just again, this idea of using, this is a business that is growing. They're generating $500,000 with one full-time and one part-time employee. I mean, those are just really good things. We're talking about some of the owner financing. Hopefully we're pretty clear on this, and if not, certainly feel free to get in touch. Alrighty, so our last quick quiz. Let's see what we got here. Our final quiz. Let's launch this. So this one is hopefully fairly straightforward, but if you could take a couple of minutes and just answer these questions, again, that just kind of help us understand whether or not we're conveying what we think we are. We take about one more minute. Ready? I'm on 5, 4, 3, 2, 1. Let's end the poll. I'm going to share the results here. So banks will expect a minimum of 20% down. Whoops, sorry, typo there. Yeah, generally speaking, it could be even higher, depending upon the credit worthiness of the applicant. A buyer needs to pay sales tax on FF&E. Yes. It's okay if you don't have a paper trail. False. Thanks. Everybody got that. You can add back the compensation of 2 owners. No, you can only add back the compensation of 1, and you can make an adjustment if the owner was making more than you would replace that individual. And we can walk through these one-on-one to make sure that it's accounted for properly. Should always include inventory in your asking price. False. True. It's up to you what you want to do. FF&E is limited to office furniture, point of sale. False. Awesome. Got it. So wonderful. All righty. So in our next session, we're going to talk about marketing strategies, financing the purchase of a small business and what that looks like. Financing will often come from many different sources. It could be, as we mentioned, a bank. It could be a gap lender. It could be the seller. It could be a whole host of individuals, and what that might look like depending upon where you get the financing and the financial implications of those things. And I know Doug and Dennis listed their financial information, and I know you all have my contact information because you've received emails from me, but please feel free to reach out to me anytime. I can answer questions. And similar to how we did the planning for this session, I'll send out a doodle poll and just try to find a time frame that works for as many people as possible. Obviously, it's not possible to make it work for everybody, but stop that. And let's see, any last questions in our chat? I am stunned that it is 10 o'clock. We are on the money. Holy cow. If anybody has any last questions or comments or anything, yeah, we'll open it up.
Kim, what do you think about, do you want to just like quickly plug or talk quickly about the potential speed networking event coming up in January and Zach might want to give a quick plug to have folks sign up for their CPR interviews if they haven't done that yet.
Yeah, perfect. Sorry, I actually meant to put a slide together. So in January, did we say it's the 27th? It's late January. We are going to have a speed networking event where sellers such as yourselves can have the opportunity to interact with the folks interested in buying your business. So it's wonderful to have kind of if you're like me, you're deadline driven, and having a deadline to get a valuation done, to get your sell sheet put together and all that good stuff is great. And we are certainly going to market the event and identify potential buyers and aspiring entrepreneurs to participate.
And I'll just quickly plug the Center for Pandemic Responses Danny mentioned and was introduced in the first session. This is this program where through an interview with one of our program navigators, you'll have access to a range of services designed to develop sort of business resilience. This is great for folks who are interested in selling a business. You're going to put together some pieces that'll really demonstrate you've thought about long-term resilience. That'll be super great for potential buyers. So do reach out to Kim and highly encourage you to have that program navigator interview and think about CPR services to sort of help you build up your business right now. Thanks.
Excellent. I think that wraps it up unless anybody else has anything else they want to share. Cool. Well, thanks everybody for your time this morning. Hopefully you found the information that was shared is valuable. I will reach out to you with those spreadsheets and like furniture, fixtures, and equipment worksheets and such. And as I mentioned, more than happy to work with you on those. Thanks and have a great day.